Most people think you need to be a math genius to understand compound interest. The truth? You only need a few simple habits, and they can change your financial future. Compound interest means your money earns returns, and then those returns also start earning returns. It's money growing on its own. Think of $1,000 in a savings account. At 10% a year, it's about $2,000 in 7 years, without adding anything extra. That shortcut is called the Rule of 72. Divide 72 by the return rate, and you know roughly how many years it takes to double. Here's the secret. It's not about finding the perfect return. It's about starting early, staying consistent, and letting time do the heavy lifting. If you start at age 25 and invest $200 a month until 65, you could retire with more than someone who waits 10 years and invests double. And why does this work? Because compound interest is exponential. Small steps today multiply into big results in the future. But compounding isn't only about growing money. It also works against you in debt. A 20% credit card bill compounds just as fast, only in reverse. That's why the smartest move isn't just investing. It's killing high-interest debt first. You're removing negative compounding from your life. The beauty is, you don't need complex math. You need a simple system. Automate savings, increase them little by little, and let compounding do the work. Automation is the key. Neuroscience shows we're more likely to stick with good habits if they don't rely on daily willpower. Set your savings to run automatically, just like paying your internet bill. Once it's out of sight, it becomes effortless. Here's another trick. Escalate. Add just 1% more whenever you get a raise. You'll barely notice it today, but your future self will thank you. Behavioral economists Richard Thaler and Shlomo Benartzi proved this in their Save More Tomorrow program. People who committed future raises to savings ended up with far more wealth. The opposite is also true. Fees compound against you. A fund that charges just 1% more in fees can cost you tens of thousands over decades. That's why legendary investors like Jack Bogle pushed for low-cost index funds. Less fees mean more compounding for you. Compound interest isn't flashy. It's slow, steady progress. But given enough time, it beats almost every shortcut. That's why Warren Buffett says his wealth came from living in America, lucky genes, and compound interest. The math isn't hard. What's hard is patience, resisting the urge to pull out your money too soon. If you can stay invested, automate, and avoid high fees, you're already ahead of most people. That's how you master compound interest, without being a math genius. Let's put it into perspective. If you invest $300 a month starting at 25, by 65 you could have close to $500,000, even with modest returns. Start the same plan at 35, and you end up with less than half that. The gap is time, not intelligence. That's the neuroscience of compounding. Our brains underestimate exponential growth. We think in straight lines, not curves. Once you understand this bias, you stop waiting for the perfect time and realize the best time is now. Even small amounts matter. $50 a month may not feel like much, but over decades it grows into something meaningful. The key isn't how much you start with, it's the discipline to stay consistent and not interrupt the process. Interrupting compounding is like stopping a marathon runner at mile 25. You're just before the best part. The last years of compounding often produce more growth than all the earlier years combined. That's why older investors often say, "I wish I started sooner." It's not regret about returns, it's about lost time. But the second best time is today. Compounding doesn't care about your past. It only cares about when you start. Compounding works best when you avoid panic. Markets go up and down, but history shows they reward patience. In 2008, many pulled money out at the bottom. Those who stayed invested recovered and gained far more over time. That's why the discipline to stay the course is as important as the amount you invest. Another mistake is chasing high returns. If it sounds too good to be true, it usually is. Stick with realistic, steady returns. Even 7% a year doubles your money about every 10 years. Debt works the same way, but against you. A 20% credit card bill can double what you owe in less than 4 years. Before chasing investments, destroy high-interest debt. It's like earning a guaranteed return by avoiding losses. Once debt is under control, focus on keeping investing simple. Complexity often hides fees or risks. Warren Buffett himself recommends index funds for most people. Low fees, broad diversification, steady compounding. So here's the formula. Kill high-interest debt, automate your investing, stick to low fees, and give compounding time. Consistency beats intensity. It's not about one big deposit. It's about steady contributions, no matter how small. Even during tough months, keeping the habit alive matters more than the amount you save. Think of it as planting seeds. A single deposit may look small now, but years later it grows into something significant. Neuroscience shows that habits are easier when tied to triggers. Link investing to payday, so you never think twice. Once you set this up, you remove stress. Your money grows in the background while you live your life. This is why Albert Einstein says compounding is the 8th wonder of the world. Not because it's magic, but because it rewards patience and systems. Here's the catch. The biggest results often come late. The final decade can create more wealth than the first 3 combined. That's why stopping early is the costliest mistake. You cut yourself off right before the reward accelerates. Investing is less about timing the market and more about time in the market. The earlier you understand this, the faster you stop chasing shortcuts and start building real lasting wealth. Remember, compounding doesn't require genius, but it requires patience, discipline, and time. Again, start small if you need to. What matters is beginning, not waiting for the perfect amount. Protect your growth by avoiding lifestyle inflation. Each raise doesn't have to mean bigger expenses. Let part of it fuel compounding. Make it automatic, so you don't rely on willpower. Systems outperform motivation in the long run. And when markets dip, remind yourself, compounding is working, even when prices are down, because you're buying more for less. Your brain will want quick wins. Train it to celebrate consistency instead of chasing excitement. Over time, the results will look less like small steps and more like leaps. This is the wealth-building secret used by investors, retirees, and even everyday families who commit to the process. So whether you're starting with $50 or $500, the principle is the same. Start, automate, and don't stop. Master compound interest by mastering your habits. You don't need complex math. You need consistency. Start today and let time do the work.